Hey guys, how's it going? Aaron here with Advantage Life. And so before we get started, just know this is not a sales presentation. What this is, you don't have to buy anything. This is the free information that you asked for. So go ahead, put your credit card away. And all that I ask you to do is to keep these things in mind. What you need to keep in mind is that anything here sounds valuable to you. Think about those in your life that could benefit from it, right? And be sure to pass that along. Because we're not trying to buy leads, we're not trying to knock on doors. We try not to cold call people because that's agitating, right? And so what we want to do is to make sure that we operate on a referral basis or for those who find our videos on the internet. The next thing is that we're growing across the United States. We're trying to get the word out about financial literacy. We're trying to help families out. We have a goal of 10,000 families to get protected. And so, if anybody you may know who wants to do this as an income base, who's trying to look for the extra income, keep them in mind also, pass it along to them. They'll be able to click the link or find a way to get in touch with us. That way, we can have a one on one meeting. And so now I know you're asking, like, who are you? What do you do? Where you come from? And so, like I said, I'm the founder of Advantage Life, will be leaving heritage for everyone. Now, what I am is I'm a partner with Integrity Marketing Group, as well as a part of the SOS team. The SOS team is the sold out service team here in Maryland. It's the number one distribution team in all of integrity marketing. And so, what are we? We are FMO. This is a financial marketing organization. When we talk about financial marketing organizations, we uh, market, we go ahead and market, and we also distribute products and services from companies like National Life Group, AIG, Allianz, Forces, and many others. All these Fortune 500 companies, these are legit companies, everybody. Fortune 500 companies. But I know some of these are going to sound familiar to you, but we also have a problem on our hands. Now, what's the problem right now? Because there's a shift in the industry. It comes from the average agent here in America is a 61-year-old white man. There's nothing wrong with being white, nothing wrong with being 61, of course, but they have one foot in, one foot out. They're about to retire, guys. And with them about to retire, these companies don't care about who you are, what you look like, where you come from. They really care about the distribution of their products and service. Now, the average age is a 61-year-old white male. Who do they usually market to? Those who look just like them, right? And who gets left behind? Everyone else. We're talking about the Gen Xers like myself, Gen Zs, millennials, minorities, and women. And right now, we're positioned to reach all of that. We can reach these people. So, number one agency builder in the company actually is a millennial black family, the Hearts. They actually $2 million earners. They're $2 million earners. And that's unheard of in this industry. It's not a good old boys club. It is the resemblance of America, where America really is. And here, entrepreneurs get paid based on the problems they solve, especially the size of those problems. And the problems that we solve in three of them. The first is distribution. Distribution is reaching people the old model overlooks. So many people get left behind. The other thing we solve is financial literacy. Most of us learn about money the hard way, which is the school of hard knocks. We fumble around through our 20s and 30s, and then we try to recover in our 40s and 50s to get retirement ready in our 60s. It's not the best practice, but it's all we know right now. And the last thing that we help solve the problem for is entrepreneurship. Real opportunities for people who don't want to work that traditional 9 to 5. I know I'm not the cubicle type. I don't want to be in the office all day. I want to do things out and about and be with my family and stuff like that. And so, as I continue to push forward, let's teach you one of those concepts, one of our main concepts that we teach here at the SOS Family and Advantage Life. So, everyone in America has some form of money. Some may have a lot of money, and some may have a little bit of money. But guess what? Money only grows in three ways. That is, three ways that it grows is fixed, variable, index. Now we're talking about the fixed variable index accounts, right? That's how money grows. Now, when we're looking at fixed accounts, we're talking about our check-ins, we're talking about our savings and CDs. And we also have the pros and cons of it coming up as well. So if you're looking at the picture, whatever side it's on, I'm trying to do this thing in one take. If you're looking at it, when we talk about the pros and cons, what do we like about our fixed accounts? Yes, they're safe. Fixed accounts are safe. They are FDIC insured up to 250,000. Some people just say $250,000. Is this is safe in the bank up to 250,000, just like it is with that shoebox money that you have in your house, right? It's safe. What do we don't like about it? That if we stash it in the house, if we put it in the bank, it's not going to grow. 0 to 1% growth. And so we have to watch for that. It's just like, man, I really like that, but it's not growing. And if it's not growing, guess what? You're victim of inflation. And so if you have inflation over time, the money isn't outgrowing inflation, you're actually losing money. And for your fixed accounts, I think we normally recommend about 3 to 6 months of your monthly expenses in there. No more, no less. You get the 3 to 6 months of your monthly expenses in the fixed account, you definitely want it there, right? And what does that look like on the growth chart? It's relatively flat when it's in there. And like I said, if it's not outpacing inflation, you're actually losing money. But let's look at the next type of account. And so when we talk about variables, when we talk about variable accounts or variable products, we're talking about your 401ks that's provided by jobs, 403bs for teachers and stuff, TSPs, your stocks, your cryptocurrencies, and even real estate. Now, the upside of this, it says is growth. We love the growth in those type of things, right? But what's the downside to it? Now, the downside is that you can lose all or a portion of that money. So if you're losing all or a portion of that money, man, you have to ask yourself that question. How much can I really afford to lose? Because the older you get, the less risk you want to take on. And if you're talking about taking on risk, that's when you use that rule of 100. That's your current age. When you subtract your current age from 100, that's like the percentage of risk that they say you should have out in the market, right? And so when you're looking at the growth chart, is that when the market is up, you're up. When the market is down, you're down. And we don't like that you can lose your money because just think about what happened with COVID or the terrorists or the war or what we have that times like the Great Depression and all the other recessions that we had. Those things could wipe people out, right? And so we just don't want to take that risk. We like the growth, but we also have to minimize our risk. And what's the last one? The last one is an index account. Now, this is where FIAs and IULs live. This is our fixed index annuities as well as our index universal life. This is where they live. And when we talk about them, the upside is that it's safe. Yeah, it's safe. Because the companies that we work with, the companies that have these, they are contractually guarantee that they won't lose your money if you put it in. So whatever money you put in, you won't lose it. That's what these companies do. And not only that, these products, they mirror the S&P 500, right? And so if they mirror the S&P 500, but guess what? The downside is that your growth is capped. Unlike the variable account where you have uncapped growth. If the market goes all the way up, hey, you're up. But when the market goes all the way down, you also have that, but not in an index. You have a floor there. Now, when we're looking at it nearing the S&P 500, let's look how the S&P 500 with those major companies like Amazon and Apple and Samsung and Nvidia, Tesla, those kind of things, right? That's what's in the S&P 500, top 500 companies in America. But let's see what happens. If the market is up 20%, what happens in your IUL? Yeah, you get 9% back, right? Now, what happens if the market is relatively good, but it's still pretty flat? Is at 8% for the year? The market was up 8%. You get all 8%. But what happens if the market goes down? Negative 38%. Negative 38%. Wow. What happens with you? Zero. In this case, zero is your hero. Zero is your hero. You're able to capture all the gains in the market without the risk of losing in the market. And this is why that matters most, right? Why does that matter so much? Is that when you're looking at the market, when the market is up, you're up. When the market is down, you stay flat. That's great. That's not a negative that you're taking on. You stay flat. And now, here's why it matters most. Most people heard of this guy, you know, they they heard a guy Warren Buffett, fixed accounts. He'll tell you they safe. We don't like the fact that they don't grow. We like the variable accounts and how they grow, but we don't like the fact that we can lose all of it. Now, index get the best of both worlds. It's safe as well as it gets you the growth in the market without taking on the risk. Yeah. And so, as I was talking about Warren Buffett has two rules of money. He has rule number one, don't lose the money. Rule number two is don't forget rule number one. And he's talking about principal protection. So let's say hypothetically you have $100 out in the open market. Now the market goes down. Market went down by 50%. How much money do you have now? Yeah, $50, $50. Now let's say the market went up 50%. How much money do you have? Most people tell me there's $100 was actually 75 because half of 50 is 25. So it takes twice as much work, twice as much recovery have to take place, or you feel you get back to zero. Yeah, because financial advisors will tell you that you had a flat year. No, I didn't have a flat year. I had a loss. I lost $25 in that process. But they'll tell you it was flat because principal protection is very important to not losing the money. Very important to not losing money. And that's what IULs and FIAs, that's what it's built around. It's built around the fact that they don't lose the money. Because if it takes twice as much work to recover, no one wants a part of that, right? And so most people you talk to, most people I've talked to, 9 out of 10, 10 out of 10, they have a checking or savings account, right? They're keeping that 3 to 6 months, or they live in check to check. So they don't have any savings saved up or anything, but they have a checking account. And then a nice majority of people, they have stocks, they have cryptocurrencies, they have 401ks forced by their job and things of that nature. Yeah. But what I realize that most people don't know about index universal life or fixed index annuities. Most people don't know about those things. And so what are we going to next? Let's look at it, man. Let's look at it right here. And so let me, matter of fact, let me show you why it's important. Not just in theory, right? We have two stories that happened in the office, two real stories in my own office. We have a young lady, she recruited a guy to her team. He was driving for Lyft or Uber or something like that. She recruited him while she was in the car. He came into the office, got signed up, got a license, but he listened to one of our first rules, which is get coverage. When you fall in the system, you come into the team, you get coverage right away, right? So she was able to write him a plan, get him covered. He was able to get licensed and start working a business. He was in the office one day. He was in the office one day, got a call from a friend, said, come help me out. Now, in Baltimore, if you know anything about being in Baltimore, what is it, interstate called 83, I-83. It's by my old house where I grew up at. Now, one of his friends had car problems and they needed help on 83. Now, 83 could bring you all the way up north through Pennsylvania, all that stuff, all the way to downtown Baltimore. So he left the office, went to go help a friend. And what do you know? He gets hit by a drunk driver and passes away. Very unfortunate, right? But the other part of that is his wife was also pregnant with twins. Yeah. So that was pretty tough that they lost him. I mean, the office, we felt the impact. He was fairly new, but at the same time, hey, there's someone who lost their life. But good thing he did listen to the young lady who signed him up and got a policy. So when his wife delivered the twins, she went to the hospital to check on them with a check. She had a check from the policy and gave it to the mom. And now those twins, they don't have to, they start with a foundation. They don't have their dad. She doesn't have her husband, but they have a foundation that they could build off of. They wouldn't have had that otherwise if he didn't listen and get his policy done. And that same young lady is struck like lightning strike twice with her. So that was later on, probably like a month or so after that, she had another person on her team that came down with cancer. But just like before, listened and followed the process, had a policy while in the hospital getting treatment. Check came, she was able to deliver the check directly to him with his family there. Yeah, and that's living benefits. Most policies don't have living benefits. So she was able to deliver the check while he was alive. So the same person, same young lady in the office with two different families with two different results. But the point was they had coverage, they had protection in place. So because they followed that system, they were able to have a foundation set up, have a foundation set up. So the two outcomes were both necessary. One was a death benefit, one was a living benefit. And I'll be honest with you, like as I get into this cause, not the cause and effect. I'm up here messing it up. If I look at the case and effect, I'll be honest with you. I really thought I was invincible till I was about 30 years old. I believe I was invincible. Couldn't be stopped. That's why I did this. That's why I did this case and effect as if I was 30 years old again. Because I just got married, just had my daughter. I was not worried about anything that could happen to me. It was like I'm invincible. So let's look at it. Now, what you're about to see here, everything here is hypothetical as if it was me at 30 years old. Oh, I hit the microphone. And so I'm looking at it as if I was 30 years old. This is all hypothetical illustration, not guarantees in here. And it's not anyone's actual policy, as I said. This is if I could go back to the 30-year-old me. And it's just so I can make sure I demonstrate how these things work. Now you're talking about a 30-year-old male paying $1,000 a month. That's let me see. Let's go to the slide and see what happens. So what we're looking at is a 30-year-old male paying $1,000 a month. That's 12 months, so 12,000 a year. With the average return rate, the rate that this is being illustrated at is 6.84. And you see within the first year, $10,514 accumulated value, as well as the $5,742 of cash surrender value and a death benefit of $297,510. Okay, so that's what we're looking at here. When we look further down, we're looking at this and saying, at 40 years old, that's 10 years, that's 11 years after starting the policy is now fully matured. What do I mean by that? When you're looking at it, you see the 163,000 is matching the other 163,000. So the accumulated value and surrender value all match each other while the net death benefit is still going up. All right. So if you have any questions about that, like I said, feel free to get a call or ask your personal questions. Because the thing is, most most agents and most clients don't even know that it takes 10 years. It takes 10 years. So the 11 years it takes for this to mature. Yeah. Takes for it to mature. And so people are thinking about it like it's instant, microwavable, but this is slow cooked brisket type of thing, right? And so when we're looking at it, we're trying to say people just seem to forget. People just don't have the information on these products, man. And it's definitely saddening that you can clearly see how how these things match up together. And if you go to the next slide here, you go to the next slide, you'll see that by age 60, you have $1 million in there. $1 million is accumulated, close to $1 million. Let me see. Start when you're 59 and you're looking at 60. It's like 1,077,076 dollars with a death benefit around 1.3 at 60 years old. Now, that's the thing I don't understand. It gets me all messed up. Like people will pay insurance on the phone, and they'll pay whatever they need to pay off their phones. They get a new fancy phone, right? People will pay car insurance. People pay for their mortgage. They'll pay 30 years for the mortgage. But what happened with this guy? He paid if he wants to pay 30 years into his insurance. People upgrade their phones all the time. They don't upgrade their insurance. They don't go look at that. So here's the part that people don't expect. You have access to this money. Now, let's just say if I would have kept this policy, I was presented with one of these policies back at that time, and then someone talked me out of it. Right? That's why I had to pause on that part. Is that man? What happens if I would have kept my policy in place? And so what happens is that if I was 60 years old and I kept this policy in place, at 60 years old, for my 60th birthday, which is 5 years before retirement, I would just take out $1 million. I mean, the cash surrender value is where you can withdraw the money and then tax code 7702 let you withdraw the money tax free. I would just took out $1 million. Yeah. And I probably would have lived. It says I could take, if I have $1 million in my account, I could live off of 8,300. Like I could run my household of five on about 7 to 8 thousand a month. Right. So why wouldn't I do this? And so when we're looking at it, it's about some years before retirement, and we're looking at it when you turn 70, that circle down at the bottom there. You stop paying when you were 60. You took out $1 million for your 60th birthday. You used about $8,000 a month for 10 years to live off of. And when you turn 70, there's another million there. Now you got another 1,152,830 there. That's how much is left. It then came back within 10 years after you living off it for 10 years. I mean, that's something pretty wild to me. This is all hypothetical and it's not showing a real return. This is illustrated at 6.84. I mean, I know people have questions, but that's why we allow you to book those one-on-one sessions, right? And so the illustration shows that if anything was to happen, you still will have access to the money and the money is growing, right? So let's just say, hey, Mr. Aaron, I don't want to pay $1,000 a month for 30 years. I know. Who wants to pay $1,000 a month for 30 years? 12,000, because I'm sure your mortgage is probably 2,500, 2,000, 2,500. But that's another topic, right? So let's look at it. Let's say, hey, I only pay half that time. Did I do that right? Yeah. Let's say I only pay half that time, right? I'm 30 years old. I pay $1,000 a month for just 10 years. Now, I'm not a mathematician, but 12,000 times 10 is 120,000. So 120,000. But then we look at the money we have access to within that 10 years when we talk about tax code 7702. I'm going to keep on saying that because maybe you'll look it up. Maybe you'll look up tax code 7702 and you'll see in this hypothetical scenario here, year four, I went and took out 40,000. Year 10, I go take out another 40,000. Oh no, year seven, I take out 40,000. Year 10, I take out another 40,000. So if I pay for 10 years, 120,000, and I withdrew 40,000 three times, put 120,000 in, I pulled out 120,000, and now I'm done paying at age 40. Now, what's important is what did you do with the 40,000? With that 40,000 you pulled out in year four, you should have went and bought a cash producing asset. Maybe you put down a down payment on a duplex, or maybe you bought a business, or maybe you did like bought a Subway or Dunkin' Donuts or something. Who knows? You did something and went and made more money. Then you did it again in year seven, and you did it again in year 10. Now you have this insurance product that's gonna hold you for the rest of your life, and you bought three cash producing assets with the money that you already spent within your policy. And so all that become a wash. Maybe you paid back, maybe you paid back your policy. Or maybe you didn't. Maybe you just said, well, my policy is going to grow as if I never touched it, and it's going to take out the 120,000 when I pass away. And that's if you just did half of that. But what if you did half of the half? Say, hey, I don't want to pay $1,000 a month for 10 years. What if I just pay for 30 years at $500 a month? Now you pay $500 a month for 30 years. As you can see here, your net death benefit $664,000. Well, I'm going to say 665,000 when you round it up, and it's slightly off the screen when you turn age 70, but you become a millionaire at 7 years old, and you have your living benefits that you can withdraw that and get your family to take care of you, and then they can keep the money any way they want. And I'm sure there'll still be some cash accumulated for the death benefit as well. So you see the max, you see that death benefit at 69. Now I don't know about you all, but I plan on living past 70 because my mother's 70 right now. I have a great aunt that lived to be 110 years old. So I'm just looking at that stuff. But some other things you got to keep in mind that even with the lower commitment of $500 a month for 30 years, it goes to show you how all this works. So if you need better understanding or need a one-on-one conversation about how this actually works so you can see it live in person or a personal plan for yourself, all you have to do is reach out. Now, the next thing I'm going to talk about as we continue on trying to respect your time is that this is what I call over the hill. Insurance has a cost curve, and it starts from the day you're 14 days old. So 14 days old to 30, your cost of insurance is going to be probably at the lowest it possibly could be for the highest coverage potential, right? And so you're young, you most likely, if you're healthy, you want to get some good coverage between that age group. Now, from 31 to 80, that cost climbs. The cost of insurance is going to climb up. And the earlier you start, the more time your money has before you hit over the hill. Yeah, that's where over the hill comes from for me. I'm just thinking that gap between 14 days old and 30 years old, great window to start a policy or plan for yourself. Now, can you get coverage? Yeah, you can get coverage at 31 through 80. Believe me, I've gotten it myself. And so, but we want to try to have the information in the hands of our younger generations before that 30-year threshold, because the cost of insurance is less. Now, we believe the simplest way to build a legacy is through financial services. Now, it's number two, right behind professional athletes, right? And I've never thought I would be saying that, hey, I'm a life insurance agent, y'all. I'm actually an educator. I've been an educator for over 3 years. Hopefully, I'm presenting well for you all to understand. I'm trying to keep it nice and dry for you all, so we keep it clear, right? So we're a different type of company, and we're looking and attract a different kind of agent. And so we're on a mission. We're on a mission to protect 10,000 families. That's the mission right now. Standing in the gap. Protection means life insurance that pays you while you're still alive, not just when you die. So every family leaves inheritance for everyone, because every family deserves it, right? And so when we're looking at it, we're talking about protection. What's protection? The protection is life insurance that pays you while you're still alive, not when you die. We talk about financial education. What's the financial education, guys? Is that you understand how money actually works. And we talk about a retirement income that is planned, not a retirement that is on the prayer. Plan, not prayer. Yes, you should pray, but you definitely want to have a plan and not just out here on the prayer. And you have a legacy to pass on to the next generation. Now you're also going to get access to tools that the wealthy families they always been using it. They always been using it, right? They've been using the tools, and that every family deserves. So you have to ask yourself, what will my family inherit? What will they inherit when you give them the education? Because here's our pledge here: we believe that funerals should not create fundraisers. GoFundMe funerals have to stop in our community, y'all. We believe that retirement should not create fear. We believe that children should inherit opportunity, not financial confusion. And we believe that wealth education should be available to everyone. And we believe that a good person, Proverbs tell us that a wise man leaves inheritance for his children's children. Yeah, we want to leave for our children's children. We plan for the grandchildren, not for our children, right? Our children want to have these tools as well. And so let's say you're open to secondary income as a life insurance, as a licensed agent. This is a professional license. Here's exactly how we get paid. Let's say, let's just go back to the example we used earlier with my 30-year-old self. If I'm 30 years old now, looking at a term policy, let's say the term policy is going to be written for 30 years, and I'm 30 years old, my death benefit is at 500,000. What happens? One of the companies say, "Hey, Aaron, that's great. Thank you for introducing us to this person that we normally can't get to. And what we're going to do, we're going to advance you 12 months in advance. So the company will get $600. And if you're an average agent at 50% contract, you get $300 for 1 or 2 hours of work." Where else can you do that? 1 or 2 hours of work, $300, not bad for the agent. What's in it for the clients that is cheap? Cheap insurance, right? What's the downside? It's going to expire. Now, it's going to expire. Now, you have to ask yourself, am I healthier at 30 or am I going to be healthier at 60? Normally, you're healthier at 30. I plan to be healthier at 60 than I was at 30. That's just me, but it's not bad. Not bad. That's great coverage. That's great coverage that's not expensive. Now, let's say that same person, the same 30-year-old me gets an IUL. And so it's the same $500,000 death benefit, but this time I pay $250 a month. Now the company is going to say, "Thank you for introducing me to this guy who's paying $250 a month." That's even less than what we talked about in the illustration. Like, he's just paying $250 a month. What we're going to do, we're going to advance it 12 months, and the company gets $3,000. And if you're the average agent, excuse me, you'll get $1,500 for the same 1 or 2 hours that you did to make the term policy. Wow. 1,500, 1 or 2 hours, no handcuffs, no sheriff knocking on the door. That's amazing, right? Not only that, you get a residual income. So you get 4% every renewal year. So every time it goes around 12 months. So if you got the policy in April, The following April, you as an agent will get $120. That's not bad for residual income for every time you get a renewal that happens. Now, it doesn't sound like much to say $120 the following year, but imagine if you're helping one or two people a month. Imagine you're helping one or two people a week. Imagine what happens if you're helping one or two people a day. At $250 a month for the client and 4% to you every single year, that's not bad. That's great. That's great for the client. That's great for the agent. What's in it for the client, right? You're getting that $120 a month as an agent. What's in it for the client? The client gets permanent. They get permanent life insurance, right? So it lasts them their whole life, their entire life. Now, there's a difference between whole life and IUL, and but they have variable life, all these different products out here. So don't get confused by that as well. But you get permanent insurance. Number two, you get cash value building between 0 and 12%. There are, we just talking about the IULs now. The FIAs is uncapped growth, but in the IUL, their products is getting 12% growth. And like I said, to take a deeper dive is actually 12 month to 12 month, which is this. If I started paying for it in April, the following April, I'll get whatever I paid in that from the April before. So April 2026, right? So if I say April 2026, I get a policy. And then April 2027 rolls around. Was the market up or down between April to April? And then if I made a payment in May, was the market up or down from May to May? And that's how you track it. That's why you want to spread your payments out, not the lump sum, because you only made one payment in January and the following January comes and the market is down, you're gonna be zero. But you have a payment from year one to year 10, and you have a different payment every single month that goes into it. Like I said, I'll have another video that breaks all that down, right? But the client also get tax-free access to the money using tax code 7702. There it goes again, tax code 7702. And you also get living benefits if you get sick or have a illness or anything like that, that you can't perform two other, what is it? You can't perform some of the daily activities. You'll get a check from the company for that as well. But you also have private pension conversion. That's the activation of income from life. Now I talked about in my example that if I had that set up when I was 30 and when I turned 60, I'd just take 1 million and discipline myself to stay $8,000 a month. Well, here you come to agreement with a power of pension. You come to agreement with the company and say, this is the income you're going to provide me for life. No matter if the money runs out, you're going to pay this to me with the income for life rider, the retirement rider. They're going to pay that to you even if the money runs out. Now, the last concept here is what we talk about annuities, right? So for anyone with an old 401k, TSP, IRA sitting there, let's roll into a fixed index annuity. In this case, they had $250,000 sitting in the old 401k somewhere. Now, what happens is that they had the 250,000. You as the agent get 8% of that, and so the company will get $20,000. Now you have the average agent contract, which is 50%. You get $10,000 for that same 1 or 2 hours that it took you to make the turn. The same 1 or 2 hours that it took you to get the IUL set up, even though the IUL has the residual income piece. But this one here is like, wow, $10,000 in 1 or 2 hours. Yeah, that's good for me as an agent. But what's good for the client? The client get uncapped growth. They get principal protection. They get tax-free rollover. They also get that private pension activation. But wait, as they say, but wait, there's more. The client also get a 10% bonus on the rollover. So when you talk about qualified plan to qualified plan, even if the client is not 59 and a half yet, where you get penalties for moving your money, you do not get it. So What's the bonus for that client? In this case, the client got an additional 25,000. That means they didn't start at 250,000. They started with 275,000. So they already came out with a 10% growth off the top. That's powerful stuff. So let's say you can see yourself doing this. You may could do it part time, right? You could do it part time. And you're thinking, maybe I can use 5 to 10 hours a week to learn this business and help some other people out. Hey, that's probably what you're thinking. All you have to do is make sure that your next step is going to be really simple. You're going to have to pass that background check. So that means no felonies involving money or finance. Then you're going to have to get licensed in the state that you are living. You get licensed in the state that you live in, but you also pay the one-time agency platform fee. It gets you access to our back office, compliance, and corporate support. Now, if you're still on the fence, here's the guarantees I have. I want to operate in guarantees. So you come on board, and even if you walk away in 6 months, you're going to learn a lot about money that you didn't know before. You're going to learn more than most people will ever learn. Just if you stay 6 months. Is that a good thing or bad thing? Exactly. So, two, you'll be introduced. Maybe oh no, you want to introduce somebody you love. You want to introduce somebody you know. You want to bring them into the fold. You want to get them policy. You want to get them protected. And if something happens to them, you know in your heart of hearts that their family is going to be better off if you had them protected, whether it be for a living benefit or a death benefit. You would have got them covered, right? So is that a good thing or a bad thing? Exactly. It's a good thing. What's the third thing I can guarantee is that your identity will grow based on the books you read, based on the rooms you're in, the people you hang around, the people that's around you, that leadership that you're exposed to. That environment is going to elevate you. So is that a good thing or a bad thing? So if learning about money, serving your community, and leveling up yourself, is that all worth it? That worth that fee? I can't think of a reason not to start. So once again, you have to ask yourself, what will my family inherit? What would they inherit if I joined the Advantage Network? What are they going to inherit if I join that network? Man, if I join the network, I'll have access to the leadership and guidance of the top people in the industry. So all you have to do now is contact the person who sent you this video or book the call for your own personal plan. So please remember this. Keep this in mind, right? You want to keep the faith. You want to love your family. You want to learn finances. And you want to leave a legacy. The legacy was prior to the comment or the DM that you sent. Leave that legacy and start the day. Thank you for joining us here, Mr. Aaron, or as they say in Baltimore, you learn with Mr. Aaron right here, and keep it going.